My name is Paul Forrester. I'm a corporate securities partner at Mayer Brown in the Chicago office, and I'm a structured finance lawyer. And I am delighted to be speaking to you today. I'll briefly introduce my close colleague, Larry Hamilton. Larry is the co-head of our U.S. insurance regulatory practice at Mayer Brown. He has a 50-state regulatory practice, has decades of experience, and has been a unique resource to me and many other lawyers at Mayer Brown on the sorts of questions that we're going to be discussing today. Some of you may have seen our earlier presentation, which we gave in December 2020, and you may be asking, why are they going over some of the same material again? And the answer is, well, it's not quite the same. The NAIC structure has changed a little bit. There's another new committee that's now running around with its muddy boots on some of these questions. And again, Larry is going to begin our presentation with an overview of the NAIC governance and structure. So Larry, over to you.
Thanks very much, Paul. And Hanson, if you could advance the slide, please. This, as Paul said, we are going to talk a little bit about who does what at the NAIC. Next slide, please. Some of this will be review, but I want to make sure everybody has the same foundation as we begin to talk about what's going on right now. Unlike most other countries, the business of insurance in the United States is regulated primarily at the state level. And to coordinate the efforts of the various states, the National Association of Insurance Commissioners, usually called the NAIC, acts as a standard setting and regulatory support organization. It's governed by the chief insurance regulators of the 50 states and District of Columbia and 5 US territories. Within the NAIC, they have delegated to the Financial Condition Committee all of the financial aspects of NAIC standard setting. And the Financial Condition Committee, often called the E Committee, because each of the major committees of the NAIC is designated with a letter of the alphabet. The E Committee actually has 39 subgroups, the last I counted, doing various aspects of financial standard setting. And we're going to talk about 3 today that have a key role in the topic that we're talking about, insurance company investments, and that are very much involved in current initiatives. Next slide, please. Here's a family tree, and the gold-colored ones are the 3 that we'll be focusing on. As you can see, they all roll up to the E Committee. One of them is the Statutory Accounting Principles Working Group, which sets, as you can imagine, the accounting, and then the Risk-Based Capital Investment Risk and Evaluation Working Group and Valuation of Securities Task Force. Next slide, please. I just want to say a little bit about each. The Statutory Accounting Principles Working Group, sometimes called by its acronym SAPWIG, governs the financial reporting of insurance companies. Insurance companies do not use GAAP for their regulatory filings. They use a special accounting system called Statutory Accounting, STAT or SAP, which is more conservative in most ways than GAAP. And it's the SAPWIG which maintains the Bible of statutory accounting, the statements of statutory accounting principles collected in the Accounting Practices and Procedures Manual. The Valuation of Securities Task Force is responsible for the credit assessment process for securities that insurance companies invest in. And it is the oversight group for the NAIC's Securities Valuation Office, SVO, as well as the Structured Securities Group, which together with the Capital Markets Bureau make up the NAIC Investment Analysis Office, the IAO, and that office has its own Bible, which is the Purposes and Procedures Manual. Next slide, please. A new group, as Paul said, was started just in 2022 with the charge of performing a comprehensive review of the whole framework used by the NAIC to monitor risk-based capital of insurance companies and from the investment side. And they started out in January by asking for input on some of their key focal points, asset-backed securities, with top of mind being CLOs, CFOs, and other securities that are considered to carry tail risk. And what are they looking at? They're looking at methodologies for capturing that risk, potentially using a modeling process similar to what's already being done with commercial mortgage-backed securities and residential mortgage-backed securities, looking at whether the residual tranche of an asset-backed security can be looked at in the same way as debt tranches, or should it be treated differently? You can imagine which way they're leaning on that. And then specific proposals for how they would deal with residual tranches to reduce what some regulators look at as arbitrage incentives. And we'll talk more about that. Next slide, please. Bond is the term that the NAIC uses generically for any fixed income investment other than preferred stock, with some exceptions, which we'll also talk about. Bonds are reported. How do you know it's a bond from a regulatory standpoint? Because it goes on Schedule D, Schedule D1 of the insurer's statutory financial statements. And it takes a risk-based capital, RBC charge, based on the NAIC designation that is assigned to it. And it used to be there were just 6 designations, from 1 being the highest to 6 being the lowest. But a few years ago, they made those more granular and subdivided them into categories that mirror essentially the NRSRO rating notches. And the advantage of being a bond and on Schedule D is as long as it's above NAIC 6, you get to carry it at amortized cost on the statutory balance sheet. And if it goes to NAIC 6, or if it's not a bond at all, then it's going to be carried at the lower of cost or market. So mark to market, which is not something that insurance company investors like to see if they can help it. The RBC factors are driven by that NAIC credit quality designation. And just to give you an idea, for life insurance companies, NAIC 1A, which is the equivalent of a AAA, 16 basis point RBC. If you drop to the bottom of the investment grade tranche, 2B, it's 1.52%. So basically a whole order of magnitude change within that investment grade band. And then once you start going below that, I'm not going to read all these to you. You can see the slide, but it goes to the ultimate NAIC 6, which is 30%, and the same as equity. And also the drop going from the 2 to a 3, from investment grade to below investment grade, you see is also quite a multiplier. Next slide, please. How do bonds get those NAIC designations that are so important in driving the RBC charge? Well, over 80% of insurance company bond investments are what's called filing exempt, which means they automatically take the NAIC designation that is equivalent on a mapping basis to the credit rating from an NAIC recognized credit rating provider. And all the NRSROs that are approved by the SEC are currently also approved as NAIC credit rating providers. If it's not filing exempt, then it has to be filed. And the SVO does its own credit quality assessment and makes its own designation to that bond. Since the financial crisis, the staff of the SVO and also that structured securities group that is like a sister to the SVO have believed that the NRSRO assessments of credit risk are not reflecting, as they put it, the full range of non-payment risks that regulators care about. And they have been looking for ways to reduce the NAIC's reliance on NRSROs. Next slide. So far, summary. 2 big things the insurers care about. 1, they want their fixed income investments to be treated as bonds on Schedule D, RBC charge based on their NAIC designation, preferably NAIC 1 or 2, which are the lower charges. And the SAPWIG decides that question. That's statutory accounting. Second thing they want is they want those fixed income investments, if possible, to be filing exempt. So they automatically take the designation equivalent to the NRSRO rating rather than having to be filed and analyzed by the SVO. And that's the valuation of securities task force that decides that. And that's why those 2 groups are so important. And at this point, I'm handing it off to Paul to get into some of the nitty-gritty.
Thanks, Larry. Next slide, please. Okay, Statutory Accounting Working Group has been beavering away since 2020 on a new definition of bond. And just to note, historically, bond as understood for statutory accounting has had a very literal meaning. If it's a fixed income instrument in form, that would allow an insurance company to treat it as a bond. And as Larry has properly suggested, there's an increasing skepticism that that literal view is really leading to meaningful treatment. And accordingly, the statutory accounting group decided to take a much more holistic much more holistic review of and a definition for what is a bond. They initially exposed a partial draft issue paper. An issue paper is the process that the NAIC Statutory Accounting Principles Group has to do when they're making a substantive change to statutory accounting. And it proposed substantial changes to SSAP 43R, currently titled Loan-Backed and Structured Securities, but about to be renamed. That draft issue paper raised significant questions about a variety of structured securities, and in particular would have suggested that unless they met the SEC definition of asset-backed securities, that they would not be properly classified as bonds. Industry, in the NAIC parlance, interested parties reacted very adversely to that proposal. There was a 67-page comment letter submitted to the NAIC on that proposal, in which they pointed out the danger in using the SEC definition of ABS. There are many instruments that the market thinks of as ABS that are not SEC-defined ABS, and pointing out that there's a risk of significant unintended consequences. Importantly to note, one of the key events highlighted in that issue paper was the treatment of CFOs, or collateralized fund obligations, which we'll be talking about today. And this very narrow definition would have clearly constituted shock therapy to the investment portfolios of life insurers, who, as the NAIC staff knows and has been researching, have been increasing their investments in alternative investments now for some time, including in asset-backed securities. And certainly, again, the industry position was probably to have been expected. Next slide, please. In any event, fast forwarding to today, it took about a year, but again, the consensus view was a principles-based approach would resolve the technical arguments that were being made on both sides of this question. And that launched into, again, a more holistic exercise. And that clearly has been at work since then. It has become the basis for proposed revisions to the two statutory accounting standards that are relevant. That's SSAP 26R, which is currently called bonds, although that will also be renamed, and as I mentioned, 43R, and they are now at a pretty advanced stage of development. The most recent drafts, which the Statutory Accounting Working Group is looking at, are now relatively complete in a pretty close to final form. They had hoped to have the statutory accounting in place for January 1, 2024, but they're now the new currently targeted implementation date is January 1, 2025. So we have a couple of years to dust this off and make sure that we can actually do it. Importantly, as is the case for most changes to statutory accounting, existing investments will not be grandfathered. There may be a transitional period in the case where there's some concern about whether insurance companies can reconfigure their investment portfolios. But again, there won't be grandfathering of existing investments. So any insurance company looking at a security which has a maturity date beyond January 1, 2025 will be asking whether that instrument is going to meet these currently debated proposals. Next slide, please. The definition has a relatively straightforward structure. A bond is a security if it represents a creditor relationship where there is a schedule for one or more future payments, and it qualifies as either an issuer credit obligation or an asset-backed security. And again, the statutory accounting proposals are to rewrite SSAP 26R and have that cover issuer credit obligations comprehensively, or SSAP 43R, which will comprehensively cover asset-backed securities. Next slide, please. Taking issuer credit obligations firstly, this generally is what you would think it would be. It's the traditional corporate bond private placement investment representing debt of operating entities or holding companies, which have a purpose other than the pass-through of investment proceeds. There's a non-exclusive list shown here, lots of conventional things. Just a couple of things to point out. One is that bonds issued by REITs and 40 Act registered funds are issuer credit obligations. Private funds not registered, which invest in exactly the same thing, may not be. So there's a pretty interesting question still to be worked out there. Similarly, this would include leaseback securities. Not clear what you have to have before it's backed by a lease, and it's not clear what you have to do with respect to extensions and renewal options in leases to figure out whether they are in fact a leaseback security or not. So while we have this useful list, again, there are some questions which this list itself raises. But again, this is a pretty easy part of this process. This is the stuff that insurance companies were doing historically and have done historically, and hasn't really generated a lot of commentary. Next slide, please. Importantly, there are a couple of special treatments. The non-security investments that will receive bond treatment under 26R, certificates of deposit, and relevant to many of you, bank loans, where they are made to operating entities, are also going to, including acquired through either participation, syndication, or assignment, they will be treated as bonds. There are, again, special treatment for certified capital companies. The SVO maintains a list of exchange-traded funds which will qualify. That's a space to watch, by the way. And then mortgage loans, which are in scope of SSAP 37, will also qualify if they are identified as credit tenant loans. Next slide, please. Asset-backed securities. This was the hard part. Oh, did I miss a slide? Yeah, let's go back to the asset-backed securities. And this again is the loan-backed and structured securities, currently named, about to be renamed SSAP 43R. ABS represents debt issued through the securitization of financial assets or, importantly, cash-generating non-financial assets. So equities, which would not be financial assets, will clearly be allowable as underlying collateral for ABS under SSAP 43R. There are, however, two defining characteristics which have to be present for an ABS to be able to satisfy the statutory accounting. The assets collateralizing the debt issuance are expected to be the primary source of cash flows, and the securitization of the assets will actually redistribute credit risk. And again, the ultimate test of that is that the investor is in a different position than if the underlying collateral was held directly. Another feature of ABS are that they're typically issued from a trust or special purpose vehicle, but the absence of a trust or special purpose vehicle is not definitive. So next slide, please. As this title notes, subordination is key. Inherent in this definition is the creditor has a senior interest in the assets of the issuer. The statutory accounting has been clarified, and it's been made clear, if not clear before, that subordinated residual interests or first loss positions are not bonds and are not able to be reported on Schedule D. They instead go to Schedule BA. But again, just to highlight, to be a bond, you have to have some subordinated interest, some significant subordinated interest that must be present. Next slide, please. Okay, digging into the conditions. So condition one, the assets of the issuer must be financial assets or cash generating non-financial assets. In the case of cash generating non-financial assets, there's an additional nuanced requirement that the assets are expected to generate a meaningful level of cash flow towards repayment of the bond. And that could be through anything other than sale or refinancing. Helpfully, the NAIC statutory accounting has offered a bright line test here. You'll have meaningful cash flow if at least 50% of the original principal will be repaid other than through sale or refinancing. Condition two, the holder of the debt instrument must be in a different economic position, and that is the result of substantive credit enhancement, and that substantive credit enhancement is through either a guarantee or some similar form of recourse, subordination and interest, or over-collateralization. And again, just to emphasize that the residual interest accordingly will not be able to be an asset-backed security, will not be a bond, and will not be reported on Schedule D1. Next slide, please. And this is where a lot of the discussion has occurred. When you have non-financial assets that generate lots of cash and they are equity, for example, collateralized fund obligations, there are some special rules. In fact, there's a rebuttable presumption that instruments which are collateralized by equity interests will not be bonds because they lack the creditor relationship in substance. However, that presumption can be rebutted if you do documented analysis that supports the predictability of cash flows. That's done at the time of the investment being acquired, and you're able to show that effectively that there's enough predictable cash flows, or in more common parlance, bond-like cash flows, then the instrument will be able to qualify as a bond under this new statutory definition. Next slide, please. Again, the NAICS statutory accounting has offered this list of factors. This is not an exclusive or exhaustive list. And importantly, the last on this list, the sources of expected cash flows, was added relatively late in this process, and makes clearer that CFOs and similar structures which have underlying equity and therefore giving off dividend distributions, et cetera, are eligible factors to be analyzed and looked to support the debt and to rebut the presumption that you've got sufficient cash flow generating assets. Next slide, please. So just the current status, August 10, the Statutory Accounting Practices Working Group exposed pretty near final, or we hope near fatal flaw versions of their principles-based bond definition, a draft statutory issue paper in full form, and text for the actual amendments that would be made to SSAP 26R and 43R. They are scheduled to discuss the comments which they have received on the comment period, by the way, expired in October. So at their next meeting in a couple of days, they will be taking up the comments that were received, and they will be voting on whether they will expose the revised drafts and in response to the comments that have been received. And then the expectation is that at the winter meetings in December, the revised issue paper and revised reporting documents will all be presented, and that's probably their final exposure before they would be adopted. Next slide, please. A number of you I know are interested in rated feeders. This has been a particular area of interest for many, and just this offers a couple of special notes. Rated feeders have become obviously quite popular for insurance companies, especially as they've extended into private credit, infrastructure debt, real estate strategies, and the like, and has received significant attention as part of the debate about what is or is not a bond and what the definition would say. At the request of industry and interested parties, the issue paper actually includes some very specific statements about rated feeders, and states that if the underlying fund holds only debt instruments and passes through those fixed income cash flows without a lot of impediments, the rated note of the feeder fund may actually have the substance aligned with a debt investment and not an equity investment. This is the first time we've seen from the NAIC a willingness to really look through a structure to substance. So this is quite a promising development, and again, makes more likely, and again, we think now clear, that rated feeders for these underlying debt strategies will be permissible investments for insurance companies in a rated feeder format. However, just before we get too excited, the last draft of the issue paper is to include, the next draft of the issue paper is to include some, quote, refined language, which identifies, quote, elements that may call into question the determination that investment is in substance debt. These were characterized as disqualifying features or characterizations. So we need to see that language before we're hung free, but the current language in the draft is quite positive, and again, does reflect a positive view of the use of rated feeder structures for underlying debt strategies.
This was actually a codicil to the first part of the discussion that Paul was laying out about issuer obligations. Remember that to be a bond, you have to be either an issuer obligation or an asset-backed security. On the topic of issuer obligation, I know some of these securities are of interest to people, so I didn't want to just lose sight of this. The general rule is that a debt instrument has to represent the creditor relationship, and it doesn't represent a creditor relationship unless it has predetermined principal and interest payments. And they can be fixed or variable, but there need to be predetermined payments with contractual amounts, and they're not allowed to vary based on the performance of some other value, a collateral value or a non-debt variable. Now, they've hastened to add, it's okay to have benchmark interest rate adjustments, so it can be tied to SOFR. There can be inflation adjustments, like with the Treasury tips. You can have scheduled step-ups, and there can be interest rate adjustments based on credit ratings, so that if the issuer is downgraded, the interest rate goes up. That kind of thing is allowed, and that's still considered a contractual predetermined principal and interest payment. What they're not allowing are two examples here: structured notes, where the contractual amount to be paid at maturity is at risk for something other than the failure of the borrower to pay the principal amount due. And those actually have been, since 2019, treated as derivatives under SAP number 86. And that's being reaffirmed and really grounded in this principle about the need for predetermined principal and interest payments. In that case, it was the principal that was up for grabs, but also principal protected securities, which have the protection of principal, but the return includes a performance component that's determined by some non-fixed income reference point. Those already lost their filing exemption a couple of years ago and have to be filed with the SVO for their credit quality designation. Once the new bond definition goes into effect, they won't just lose their filing exemption, they will lose their status as a Schedule D bond. And they will be treated as non-bond securities under SSAP 21, which is being amended to include provisions for them, and they will be reported on Schedule BA. So if people were quite concerned when these so-called principal protected securities, which sounds like a good name, but it's actually a bad name in the NAIC world now, lost their filing exemption, meaning that they got much lower NAIC designations than what the NRSRO credit rating would have indicated. But they're now being pushed down to a lower circle within the inferno of not even being bonds and being Schedule B assets. Now, exactly how they'll be treated for RBC purposes is still to be determined, but I just wanted to point that out because that's historically been a point of interest.
Thanks very much, Larry. Yeah, I think I skipped that or it wasn't shown up. We've had a couple of questions which I could address now. Just again to confirm, we will be distributing the presentation slides post-seminar. And a question was asked about whether the RBC is, whether the NAIC is looking at the banking industry attempts to grapple with these same questions. I'm not aware of any particular reference, although I'm sure they're familiar with that process and some of the outcome. It should be known or understood that the NAIC RBC model is quite different than the banking capital rules. And so and again, in sharp contrast, perhaps to Solvency II, which really does bear a lot of similarities to the bank capital requirements, the NAIC models and rules do not. So they would have limited utility or application, I think. But again, very good question. So thank you for those. So as Larry mentioned, one of the things that were initially targeted for RBC change was CLOs, and that's come to a head quite recently in a pretty interesting way. Next slide, please. So the Investment Analysis Office had proposed in May in a memo to the Valuation of Securities Task Force that investing in CLOs could constitute RBC arbitrage, which is obviously a hot button, and recommended that instead of filing exemption and NAIC designations being based on NRSR ratings, that instead CLO investments would be designations for CLO investments would be based on a structured securities group modeling process that would eliminate the RBC arbitrage. And they pointed to the similar experience for RMBS and CMBS that was instituted in 2009, 2010, post the Great Financial Crisis. A couple of notes before we move on. One, that RMBS, CMBS effort was actually an industry initiative. The industry went to their regulators and said, the rating agencies post the Great Financial Crisis have lost their minds. They're punishing these securities unreasonably. And the willingness to adopt a modeling proposal was in fact to result in RBC relief for insurance companies from that which they would have to hold were the old system to have stayed in place. This is not. This is in fact the opposite of that, where again, using the banner of RBC arbitrage, the NAIC is now insisting that all investments in this category be modeled. They also had a second swipe at CLO equity and noted that the NAIC 6 designation was just a single category. And in fact, they proposed splitting it with a 30% RBC charge, that it be split into 3 categories and that there be a referral to one of their sister groups to assign RBC factors of 75 and 100% to 2 of the new categories. So a much more punitive, draconian capital charge for investments in these categories. That remains with the RBC IRE working group, but again, pretty clear shot across the bows for CLO equity. There have been extensive comments made to the NAIC in this regard. They took issue with the the assertion that there was RBC arbitrage going on, and they pointed out that that's only true if you hold a complete vertical strip in the underlying. It's not true if you hold individual tranches in CLOs. Unfortunately, that seems largely to have fallen on fallow ground, and the NAIC process is moving forward. Next slide, please. As I mentioned, there were significant industry responses. At the meeting in June, the chair of the task force originally directed the Investment Analysis Office to expose the memo and to start drafting amendments to the P&P manual to implement the recommendations which the IAO had made. That got everyone quite excited, and as it should, because it appeared that the NAIC was on a very fast track to make these changes. 8 comment letters were submitted, as I mentioned. They highlighted concerns about, 1, the aggressive timeline, the need for an adequate opportunity to evaluate such an important change. The data suggests, by the way, that U.S. insurance companies hold $220+ billion of investments at CLOs. So this is not while it's not a big piece of insurance company portfolios, it's not an insignificant piece. And they certainly suggested that the process seemed to be sufficiently curtailed that it would have limited transparency and an opportunity for interested parties really to participate in the development of the methodologies and the models to be used. They also stressed the importance of CLOs to the financial markets. As many of you know, CLOs hold about 60% of the total leveraged loan market. That's $2.something trillion at this point. So there's a lot of money at stake. And candidly, they also questioned the need for this step when the historical performance of CLOs over several credit cycles has really been quite strong, and really do suggest that there's something about CLOs that makes their performance better than one might have just expected based on the underlying assets. Next slide, please. So at the meeting in August, the chair exhibited a different tone, seemed to have heard the comments, and took some pains to clarify that we're now on a much more deliberate, transparent process, and that there will be plenty of opportunity for industry and interested parties to weigh in on the methodology. And importantly, they stressed the need for close collaboration with the risk-based capital investment risk evaluation working group. However, the chair also said that increasing RBC charges on residual tranches is a shorter-term project and doesn't need to wait for the full development of a CLO modeling proposal, and suggested that there should be a more urgent attention paid to the appropriate RBC charge on CLO equity. So clearly an interim for insurers who are active investors in CLO equity. And the IAO staff presented slides which obviously purported to respond to the comment letters, although they really constituted essentially a defense of their original positions. They did indicate a timeline that would show the bulk of the work to be done in 2023, possibly into 2024, with an effective date of December 31, 2024. And the staff slide presentation was exposed at the VOSTF meeting for further comments through September 12. Next slide, please. So we mentioned them a couple of times. Larry, is this you or is this me? I'm sorry, I found.
I'd be glad to jump in here.
Yes, this is you.
Okay. Thanks, Paul. So that mysterious new working group that we talked about at the beginning, the risk-based capital investment risk and evaluation working group, they did not meet between, at least not in a public meeting, between January and August, but August 11th, they did meet at the summer national meeting of the NAIC. And the chair of that meeting, who's Phil Barlow from the District of Columbia Insurance Department, and an actuary by training, emphasized that there needs to be collaboration between his working group and the valuation of securities task force. And frankly, reading between the lines, a little bit of a feeling that the initiative that was prompted by the staff of the Investment Analysis Office and taken up by the VOS task force in June was maybe getting a little bit ahead of the game and not enough coordinated with the group that's actually been charged with looking at RBC on asset-backed securities, namely this RBC IRE working group. So I think going forward, there is going to be more coordination and more collaboration between the two. But that was very interesting what Chair Barlow had to say at that meeting, said that there were a number of objectives that he had for his group. One of them, and some of these are pretty aspirational. For example, he said it should be possible to easily determine by looking at an insurer's annual statutory statement how an investment is classified for RBC purposes. That isn't the case now. You can't just look at the investment and say, now, what is the RBC associated with that? So a second point is that it should be clear what are the criteria that the SVO takes into account and doesn't when they assign a designation. So SVO, let's remember the division of labor here. I'm just going to take a step back. Statutory accounting principles decides if it's a bond or something else. Valuation of securities task force decides what's the credit quality designation. Currently, the credit quality designation drives the RBC factor because that's a grid that maps a credit quality designation onto an RBC factor. So here's the chair of the special RBC working group saying, I want to know what the SVO is analyzing when they assign a designation so that we in the RBC working group can assess whether that designation should continue to directly translate to an RBC factor or whether more inputs are needed. So he's actually questioning whether this automatic mapping process of credit quality onto RBC is the best way to approach it, and saying if it is going to be the way we approach it, we want to know how that credit quality designation is being calculated by the SVO. And then raised another really good point, which is what about new types of assets that are invested in by insurers, and the SAPWIG hasn't decided how to classify them, and the VOS task force hasn't decided how to assign quality designations to them. So this group has really set quite an agenda for itself. And next slide, please. The other thing that Chair Barlow had to say at that meeting was that the American Academy of Actuaries had been recruited to assist the group with the CLO product. And a representative of the Academy was actually there to say, yes, we're here and we're reporting for duty. We're going to work with you on this. And then there were some questions about this whole RBC arbitrage question that Paul has talked about. This idea as whether all of the tranches in a CLO should have RBC that adds up to 100% of the RBC that would exist if the underlying were being held. And so he asked, if you're trying to fix that problem by putting more RBC charges on the residual tranche, is that enough? Will the residual tranche solve it? Or would you think there's arbitrage even above the residual tranche? And the chair of the SAPWIG said, well, we think, or the SVO thinks that maybe even 100% charge on residual tranche won't equate this full stack RBC to the underlying RBC, and may need to look at the lower rated MES tranches. So that's something to watch clearly. And then the chair of VOS stated that she would really like to just stick with the residual tranche for now, and only in the longer term project look at other tranches. So very, very interesting developments here, especially with this third group now in the mix. Next slide, please. Okay, at the October 20th Voss Task Force meeting, actual amendments were exposed for comment to the PNP manual. And what those amendments say is that beginning with the end of the year 2023, the Structured Securities Group would assign CLO investments a credit quality designation based on a modeling methodology, which is currently the case for MBS. And really all they did with these amendments was wherever it said RMBS and CMBS, they added CLO before it. So now it says CLOs, RMBS, and CMBS, and they added a definition of CLO to go with it. So nothing about their methodology yet or any scenarios, just that they would, starting at some point, which they've tagged year-end 2023, that would be modeled. And the SSG would model these investments under a series of collateral stress scenarios to assign a designation to each tranche. And they stated again their goal that owning all the CLO tranches should be the same as required for owning all of the underlying loan collateral. But at this point, I want to add the amendments that they're proposing just say that CLOs would be modeled along with RMBS and CMBS. They don't say how. This part about having to equate the aggregate RBC factor for owning the stack with the RBC for owning the underlying, that is the view of the staff. That is not embodied in the actual amendments to the PNP manual. Next slide, please. My prediction is that at the next meeting of the Voss Task Force on December 14th, they will adopt those amendments. They've been exposed for comment. Comment period ends December 5th, but I think they will be passed. The question is what happens after they're passed? Whether the methodology that is developed, not just the framework that they're modeling, but how are you going to model, whether that buys into what staff is advocating for this 100% no arbitrage rule or not. And that's as yet unknown. So the SSG staff said we need to adopt these amendments now because that's going to enable us to get the budgets that we need to do the work in the coming year. And they also stated they're only looking to model the broadly syndicated CLOs at this point. Later on, they may address middle market CLOs. And so it's, I think, going to be a done deal that there will be modeling. But the fine tuning of the methodology is where industry will have an input. And then as I alluded to before, they also did a concurrent referral to the RBC IRE working group that they're really going to do more coordinating. And I've already mentioned, I think December 14th is when they adopt the modeling concept in the PNP manual. Okay, next slide, please. Back to Paul. Talk about ratings.
Sorry, before we move into NRSR ratings, just to answer a couple of questions which have been raised. One was, would catastrophe insurance-linked securities be considered bonds? I think the answer is they should. They would strike me as being able to meet the definition of asset-backed security as it's now proposed. And the other question we'll address now. Well, you've heard, and probably reading between the lines would realize there's certainly a good deal of skepticism at the NAIC about the value and the reliance, the degree of reliance of industry on NRSR ratings. And that got brought to a head when in October, the Valuation of Securities Task Force adopted two new charges. One was to implement additional alternative ways to measure and report investment risk. They've actually started to do that. There are now more data fields required potentially for Schedule D1 reporting than was previously the case, including some market-based data. And then secondly, to establish criteria which would allow the staff to exercise its existing authority over assignments of NAIC designations that are subject to the filing exemption process to ensure greater consistency, uniformity, and appropriateness. And of course, that means we could, even though you've got filing exempt status and you've got an NRSR rating, if we don't like it, we could change it and designate it something else. So that's a pretty big deal. At that meeting, a lawyer from Paul Hastings spoke up on behalf of Egan Jones, objecting to those additions to the valuation of securities 2023 charges, and warned that the adoption of this new charge, giving the NAIC staff this authority, potentially raise some anti-competitive antitrust issues, and that the NAIC's adoption of this new power would override credit rating provided ratings, which would have a direct and negative effect on them. And certainly, they noted that the proposal to implement the modeling the CLOs in place of the credit rating provider ratings was similarly anti-competitive. So there's going to be more to be heard about this, but again, the latest evidence of this friction has been made clear. There was an earlier paper presented to the Valuation of Securities Task Force, I think it was in November of 2021, by the Investment Analysis Office, in which it purported to examine ratings and to have determined that there was a pretty low correlation, if any correlation at all, and that therefore rating shopping and other bad things could occur. And they proposed to the Valuation of Securities Task Force a number of measures, including a minimum of requiring at least 2 ratings for every investment, which would increase expense, and that if you have 2 ratings, you would use the lower of the 2, not the higher. So that actually is the current rule, by the way. Some kind of rating utility where, like the Franken rule and Dodd-Frank, somebody would be assigning randomly rating deals for rating to rating agencies, and a bunch of other issues, which again, nobody has really taken up. However, the Valuation of Securities Task Force response was to organize an ad hoc committee, which has been meeting since then. Because it's ad hoc, it's not subject to reporting or sharing minutes and notices of meetings. So we don't know how often they've met. We don't know what they've been discussing. At the last Valuation of Securities Task Force, there was meant to be a report from that ad hoc committee. They reported there was nothing to report. So it's a little unclear exactly what that group is up to. But again, you're certainly going to see more about the utility of NRSR ratings and a continued effort to circumscribe them, or at least reduce the degree of reliance by insurance companies on NRSR ratings for a variety of structured securities. Next slide, please. Okay. Sorry, I'm slow reading and seeing the change. Something going on with my computer. On October 20, Valuation of Securities also exposed proposed amendments to the P&P manual. This is in relation to the proposed addition to their 2023 charges that would allow the designations to identify a category of band of credit risk that reflects likelihood of timely payment of principal and interest, the appropriateness and consistency of its use in accordance with the NAIC policy statement, including risk-based capital model factors that will be applied given its level of risk. This appears to be a direct response to correspondence, which we understand has been taking place between Paul Hastings on behalf of Egan Jones and Wilson Sonsini on behalf of the NAIC, discussing the antitrust and anti-competitive allegations which Egan Jones / Paul Hastings has raised, and an attempt to distinguish NAIC designations from ratings. I'm not quite sure I see the difference, but certainly, again, this appears to try and draw lines and to suggest that somehow NAIC designations are different from and not to be confused with NRSR ratings. I think we've heard anecdotally too that the NAIC SVO staff has its own views about who are good rating agencies and who are not. Not quite sure exactly how broadly that information is shared, but they certainly appear to have issues with some rating agencies. And if they didn't before, I suspect they now do with Egan Jones. Oh, I see one has come in. The question is the NAIC contemplating outsourcing the CLO analysis to a third party as they did for CMBS and RMBS with BlackRock and PIMCO? I don't think we know definitively. I think the current indication is they are not going to do that. The risk-based capital investment risk and evaluation working group actually asked that question at the outset of its deliberations and concluded, at least tentatively, that third-party assistance was not required for this exercise. Again, they don't count the American Academy of Actuaries as third-party assistance. So with that exception, I have seen no evidence that they're likely to ask third parties to get involved.
But that's not a done deal yet. We don't,
No,
that's part of what's yet to be decided. Just bearing in mind, when the CMBS and RMBS were put under a modeled structure, that was done at the request of the life insurance industry that approached the Valuation of Securities Task Force, seeking relief from, at that point, the punitive credit rating and the impact that was having on their RBC. And they proposed the modeled approach as an alternative to using the credit rating and to help them out of what would have been a very difficult situation based on the RBC impact of the ratings going way down. So in this case, the initiative is coming from the NAIC staff. So naturally, they think that they have the tools to be able to do this. But as things developed, and particularly if the life insurance industry decided to become advocates for a third-party outsourcing, it's possible that it could be considered. But I agree with Paul. That's not what they're saying they want to do now.
Right. We've had a couple of other questions. One asking, what do we think about rated notes on private equity funds? We like them. Seriously, I think the question was directed to, will they qualify as bonds? Obviously, because the underlying is equity, you're going to have to go through the rebuttable presumption, assuming that your documented analysis shows sufficiently robust cash flows, other than for sale or liquidation of the underlying. So just what's going on with the underlying companies in which all those funds invest, and not sale or liquidation of the fund interests. Then I think the answer will be it's a bond, but clearly depends very much on the nature of and the status and how mature the private equity funds are. But clearly sources of funds include dividends and distributions, so you could look to those. And again, if they show robust enough bond-like cash flows, it should be a bond, and you'll be able to demonstrate how you would overcome the rebuttable presumption that applies. I think we've had a couple of other questions. I'm reading them live. Yes, somebody asking about a thing we pointed out in our last presentation, which was an issue paper, again, out of the Investment Analysis Office, asking about the risks of, pointing out the risks of bespoke securities. Nothing really new on those bespoke securities, although just taking stock, principal protected securities have been attacked and dealt with. Rating agency clearly has gotten some focus and attention. And certainly you've got things like the clarification on how the equity residual tranches of ABS has to be on BA. Although again, as Larry has pointed out a couple of times, if you push it there, what happens with the RBC treatment? Is it the same or different? And that has to be answered yet. And
private letter rating was another one where they've.
Oh, thank you. Yes, the private letter rating. Yeah, we've talked about that in our last presentation. They've taken that away and effective last year, starting last year, although effective for everybody this year. You're meant to be filing private letter rating rationale reports, and the expectation is they'll look like the public rating reports. And we certainly are expecting to hear eventually from the securities valuation office as to whether they've found bad acts in those private letter ratings. And again, it would be clearly fuel for any attempt to exercise that authority they're clarifying, whereby they could step in and take away and redesignate NRSR ratings differently. So that's certainly something that would be on the radar, I believe. But nothing other than that. So how'd you like to play, Mrs. Lincoln? Seeing no other questions, again, we'll thank you very much for your attention. We will be sharing the materials and the recording of the webinar on mayorbrown.com. And of course, as always, feel free to reach out to Larry or me if you have any questions. But thanks again, everyone.